So in this lecture, we're going to define liabilities. According to Fundamental Accounting Principles, Wild 22nd edition, liabilities definition is a creditor's claim on an organization's assets involves a probable future payment of assets, products, or services that a company is obligated to make due to past transactions or events. Key components here include the fact that we're talking about a creditor's claim. That's going to be a third-party claim, and we're talking about a future payment from the company that's going to be in the form of assets, products, or services. So remember, we're not thinking of just cash. Cash is going to be one form of payment in terms to pay a liability, but that payment could take the form of a type of asset other than cash, as well as products or services that would be due in the future. Also important to note that the liability must be due to a past transaction. So if we owe something in the future, the reason we owe it is because something happened in the past. It's got to be as a result of a past transaction. Liabilities examples are going to be something like a loan. If we loan from the bank, past transaction being we took a loan out and we owe something in the future, probably cash. Could be a vendor as well. A typical type of liability, accounts payable, would be that we purchase something on account, then we owe something in the future in a similar way as if we purchase something on credit or something like that. We would also have a situation where if a customer prepaid for a job, if we bid a job, customer prepays for the job, we're going to do the job in the future. That's one of these areas where we have a liability, but the liability does not involve future payment of money in this case. It involves future payment of services in this case. We're going to provide our work in the services. That's also a form of a liability.